Hi everyone, and welcome to the first video of the Academy, where we will be discussing the repo market, its importance, and how it works. The repo market is a short-term lending market where typically banks and other financial institutions like hedge funds or money market funds borrow and lend money to each other using securities as collateral. It is an important tool for managing short-term financial needs, and it's designed to absorb the excess liquidity from quantitative easing and to facilitate the Fed's interest rate policy. So, first of all, let's give you an idea of how a repurchase agreement or repo deal works. As we said, a repurchase agreement is typically an overnight deal between two parties that agree to buy or sell US Treasury securities with the promise to return them back the next day at a slightly higher price. Basically, one party lends the cash in the repo and the other borrows it, offering a security, like a 10-year US bond or a 1-month Treasury bill, as collateral for the transaction. The borrower is said to be doing the repo, while the lender, instead, is said to be in a reverse repo. The day after, typically, the borrower gets his security back, or, as we should say, it buys it back at a higher price, and that difference in price is an interest rate called the award rate, if the deal is conducted with the Fed, or SOFR, from Secured Overnight Financing Rate, if the deal is between two regular counterparties. Let's give you an example. In a reverse repo agreement with the Federal Reserve, the Fed sells the treasuries from its balance sheet to banks and commits itself to buy them back at a higher price the day after. The award rate in this case turns into a profit for the bank that is effectively lending money to the Fed. Now that we have understood how the deals work inside the repo, let's focus on how it did grow to the over $2 trillion beast that it is today. Welcome inside the dashboard. Let's look together at our first chart, the repo award rate chart. Here we have the size of the repo market in yellow, the award rate in orange, and other different interest rates that influence it. We'll go through those one by one, don't worry. On March 2021, you can also see this dash white line, when the Fed decided to let the changes to the supplementary leverage ratio, or SLR, expire. The SLR is a regulatory requirement for banks that adjusts the liability to asset ratio inside their balance sheets. The reason behind this was to ease the financial system during the COVID crash when bank deposits went up sharply while interest rates dropped dangerously and were close to becoming negative. This is because, from the perspective of the bank's accounting, deposits are, in fact, liabilities to their customers, and the SLR is that rule in place to mandate that on the asset side of the bank's balance sheet, the liability is offset by an asset, like a loan, for example, or a US Treasury. But during the COVID crash, what happened was that the liabilities went up while loans didn't follow. So the only way for banks to maintain a correct asset to liabilities ratio was to go purchase US Treasuries. As you may know, the price of a treasury is inversely related to its yield, so that amount of demand, with yields being already in the negative territory, could have pushed the rates down even further, causing some serious potential strain on the treasury markets. For this reason, during the COVID crash, the SLR was lifted, allowing banks to store the excess liquidity from QE. But then, 1 year later, it was reintroduced, right here in March. At the same time, the Treasury of the US chose willingly not to produce enough short-term treasuries, causing a shortage in what is normally favored as the best type of collateral asset because of its non-volatile nature. Instead, the repo award rate was set by the Fed above the lower band of the federal funds rate, in red in the chart, which is the rate at which US banks lend to each other in the federal funds market. The award rate was also tailored to remain above the yield of the 1-month Treasury bill that you can see here in blue. The Treasury bill, or T-bill in short, is the typical investment product for all money market funds. But what is a money market fund, you may ask? A money market fund is a type of mutual fund that invests in low-risk, short-term debt instruments whose goal is to provide private investors with a low-risk investment option that offers relatively stable returns. Treasury bills issued by the US government are, on the other hand, considered to be amongst the safest investments in the world, so it's typical for a money market fund to have a significant portion of its assets invested in T-bills. So, these clever changes to the interest rate policy basically provided the economic incentive for all banks and all money market funds to store all the excess liquidity of the US financial sector inside the repo market, while simultaneously allowing banks to get their hands on the treasuries that they needed to meet the regulatory requirements. A brilliant move. In synthesis, while the award rate stays above the lower band of the federal funds rate, banks are likely to keep their liquidity in the repo. And while the award rate sits above the 1-month treasury yield, the private capital invested in money markets is also likely to sit inside the repo. While, when the yield exceeds the award rate, as for example is happening now, money markets are likely to participate to new debt auctions from the Treasury to try and scoop up all the Treasury bills that they can put their hands on, drawing liquidity from the repo market in the process. In conclusion, the repo market is a very important tool for the Fed's policy. It sucks up liquidity from banks and money market funds, effectively removing it from circulation and subtracting it from the net of US liquidity flows in the markets. But it can also pump liquidity back out when the time is ripe. We'll see how this works and what it can mean for asset price valuations in the next videos. Thank you for watching, Wizard, and don't forget to subscribe and turn on the bell icon if you don't want to miss our next releases.